Welcome to another episode of Read the Bull, the only podcast dedicated to finance and investing books and the stories about how they got published. I'm your host, Stefan Prelog, and today I'm thrilled to welcome my guest. She's a former partner and senior portfolio manager at Canyon Capital, a $25 billion hedge fund, and author of Damsel in Distress, My Life in the Golden Age of Hedge Funds. See? Welcome, Dominique Mielle.
Thank you for having me.
Thank you for joining us. It's so great. I want to start first by saying I love the book title. It is just perfect. And as you read it, it really fits the tone and style, and you get a real sense of your personality. It's just such a great title. So congratulations on that.
Thank you.
Yeah, it's great. It's witty, and it captures a lot just in that title. And so I want to get into all this. But, first, I've thoroughly enjoyed the book. We'll talk about how we got to know each other a little bit. But this is my second time reading it. And as I said to you, I enjoyed it even more the second time. It's a book that raises important issues, really without being, heavy-handed. It's told through your unique experience. And you are someone who's had a front row seat to the rise and really fall of hedge funds. And you're also a CLO pioneer, a title I know you're proud of.
Very, yes. That most people wouldn't begin to know what it means, but at the time it mattered to me. It matters a lot less today that I'm not working. But thank you for saying all those sweet words. It really makes me so happy to hear them.
Yeah, it's a great book, and CLO Pioneer is still something I think to be very proud of, even in retirement. So I think it's such a great book because there are not a lot of books about the adventures of working in a hedge funds by a woman, which I think is very unique and needed, obviously because there are not a lot of women in hedge funds, and we'll get to that. But I think it's such a great just story about your life in hedge funds.
No, you're right. It's actually the only memoir by a woman in hedge funds. There have been a few books written by women about hedge funds. One, I don't know if you read it, but Black Hedge is about the Steve Cohen hedge fund, and that was written by a female journalist. It's a brilliant book, but of course she's not a practitioner.
Sheila Katkar, right?
Exactly. Yeah. Fascinating, thrilling, page turner. But she did not work in that environment. There have been books about women in investing on Wall Street and a few in hedge funds, but never by somebody who's been experiencing it.
Right.
I thought there was a potential market for that, for my story.
No, 100%. I think it's well needed. It is a great story. So I want to get in, just start with your early career and talk about how you ended up working at Canyon, because you didn't take the traditional finance route. As people can probably hear, you are French, and you had kind of an interesting path. So, and I think that, that benefited your career, and I want to talk about that. But how did you end up at Canyon?
It's true. There was a lot of serendipity, and I like focusing on it, or at least pointing it out, because I think when people read finance books and books about investment managers or Wall Street, there's this narrative that these people sort of found a calling in childhood, that they were meant to be financiers, that they were chosen by, the god of Wall Street, who imparted them with all those skills and gifts that they very quickly recognized and utilized.
Of course.
And the truth of it is, it's not true in the field. And I wanted to show that you can have a very fulfilling, successful career, even if you didn't think that you were even interested in finance. I certainly had no thoughts of going into finance. I was born and raised in France, and I took a job in banking in New York because I wanted to explore the world, because I wanted to get out of Paris and France. And I had a few choices, that one in particular that had nothing to do with finance, and this one that happened to be in banking, but it could have well been, basket weaving in New York for all I cared, because I thought it's going to be so fun to move and meet new people and live in a different country, in a different city. So that really was it. That's all it was. It was adventure seeking.
Yes.
Then after that, I went to business school, and that's after my first job in New York. I got a job at Lehman Brothers, mostly because my boyfriend at the time worked at Lehman Brothers, and so it seemed like an extremely good idea to to to
Sure.
follow him in his job, particularly because, as you know, investment banking is an all-encompassing type of job. So he spent, 15 hours a day at his job. So
Mm.
I thought, well, if he's going to be there, I might as well be there as well to be with him. That was the extent of my motivation. So as you can see, not very deep rooted.
Yes.
And it's not until I went to business school and took a few classes that I really thought investing is for me.
Mm.
I'm very interested in it. I think it would be worth exploring getting a job in that field. And after business school, I found this little known scrappy firm called
Yeah.
Canyon Capital that had 5 or 6 people. It was in LA, which I thought was very attractive, and it was a great adventure. I stayed there my entire career for 20 years.
Advance your career, you start to specialize in certain sectors in telecom, and then airlines. And we should point out this is, well, first, you started at a very auspicious time too. You started right as LTCM was going bust, and then had a 20-year career, but you entered at a very interesting time just in markets, as this hedge fund, was deemed to be systematically important, and was rescued. But you said you were just happy to be working there, and it was a kind of you saw it as a thrilling adventure.
Yeah, it was, the late 90s. And so it was very lucky in the sense that hedge funds were beginning. There was then not a lot of competition. They were firms that were very nimble. It was a great time to start. So, again, in a finance career, one would think, reading a lot of the books around, that you have to be extremely motivated, very skilled, etc. And it's true, but luck in every career, every life, luck is a huge factor. And I was very lucky to find Canyon and to enter at a time that was very propitious for the growth of hedge funds.
Yeah. So when you joined, how big was Canyon?
It was 500 million in assets,
Wow.
and we were probably 10 people or so.
Wow. Yeah. So you can see where the trajectory was. So good time to be there. A golden age of hedge funds, obviously. But you were allowed to also kind of indulge your creative side, and you got to specialize in these sectors. And you talked about around 2000, we obviously had the dot-com bubble. But you said that the media incorrectly describes the dot-com and telecom busts as one and the same, and you note they were not. And you talk specifically about WorldCom, or WorldCon, as your son called it, and the bond investment, and talk about what happened with the bond investment with WorldCom.
I talk about WorldCom because it was probably the first one, or maybe the second one, of my biggest losses. And it's a very searing event when you're a junior person and you have a position that is attached to your name. It's very exciting because in the beginning you're really more of a help, and you analyze positions for other people and help them build a case. But this was kind of my own position. And WorldCom, I mean, I'm sure a lot of people will not know what it was, but it was a very large telecom company, much alike AT&T or Verizon, and they had a long distance business. They had an internet business. They were starting, I think, at the time in the wireless business, and they had made a lot of acquisitions. Their accounting was somewhat difficult, and you have to remember that at the time there was no Sarbanes-Oxley rule that requires the CFO to sign off and opine on the audited financials. The story is that I bought bonds at 96 cents on the dollar that were supposed to mature a few months after. And the company had already some problems. There were some cracks in the wall of the edifice of the huge company that was WorldCom. The CEO had been caught asking for a loan by the company that was, very questionable. So there were definitely question marks, but in my great wisdom, or so I thought, I believed that the company had enough wherewithal and cash flow to pay my bonds off a few months after. So I remember one day stepping out of the office for an hour or so, coming back, and the head of research called me into his office and said, "Were you in your office right now?" And I said, "No, I was just out and about for just an hour." "Why? What happened?" "There's some news in WorldCom. You better check it out." Again, in my naivete, I thought, they paid me off in advance.
Yeah.
Excellent. Look at me. What a smart girl.
Yeah.
And lo and behold, the announcement was that the SEC had uncovered a massive fraud in the books of WorldCom. And the company was not only running out of money, but was evidently going to file for bankruptcy. And my bonds, in a matter of hours, went from the 90s to 20 cents on the dollar.
Right.
And I just remember that your whole world literally collapses around you. And and I was called, obviously, into the office of the two founding partners for a little get
Yeah.
together about that situation. So that was very dramatic.
And this gets into a little bit, if people know about distress investing. It wasn't the end of the story because you were able to recoup something eventually.
It never is the end of the story
Right.
in distress, because in investing in general, right? Because a new
Yeah.
price begets a new analysis. And so obviously I had made a huge mistake. I was had been extremely wrong. But really, the question then at hand is, what about the bonds at 20 cents?
Right.
Should one buy them, hold them, or sell
Right.
them? And the investigation starts again with new facts, assumptions, and the opportunity to make money back, or at least claw back some, is there in front of you. And that's, again, what makes this job
Yeah.
so fun and thrilling and exciting, is that there is a decision to be made at every point. And we did end up doing well, very much despite myself, because I was a frozen
Yeah.
wreck, as you can imagine. I mean, I just wanted to call my mom at that
Yeah.
point. At that point. But my partners had seen that story a couple
Right.
times, and they helped me through just reevaluating the position, the size of it, the upside and the downside of it. And, I clearly remember that they were the ones who helped me actually buy more
Yep.
bonds and switch into different bonds at different prices and make that position eventually a winning one. But again, it took a very long time, and it was years
Yeah.
until that bankruptcy unfolded. It really required the help of somebody who's gone through that trauma before.
Yeah.
In a way, it's an incredible experience to have a job where being wrong is part of the daily business, right? If you think of it, it teaches you resilience
Mhm.
in a very formidable way, because you will be wrong a
Right.
lot.
Yeah.
Sometimes big, sometimes small, but a lot.
Yeah.
And the entire job is to just move forward and understand why you were wrong and try to make it back, and just act like failure is business as usual.
I'm loath to bring up a sports analogy because you know in the book you're not a big sports fan, but it is like being in baseball. You're going to fail a lot of the time. It's that hitter coming up, and you have to forget kind of what just happened and go back and do your job. Um, and yeah, you making mistakes can help, and you learn from them. And not, yeah, I think that's very evident. And you make it very interesting. You make distressed investing very interesting, and telling these stories. And what you said earlier is some of these companies go into bankruptcy more than once. So you get familiar with them, you get familiar with their story, and they have all different stages, going from being a startup to mature company to, maybe taking on too much growth, evolving, going into bankruptcy, coming out of bankruptcy. There are all these different stages. And a lot of people may not think about that a company has an arc like we do in our lives. And as for you as an investor, it's to really understand that and to look at the opportunities across those different stages.
Exactly. And what was so interesting at Canyon is that we could invest in that whole cycle.
Yeah.
We had vehicles and we had pockets where we could invest when the company was very distressed or in bankruptcy, but also when it was mature. And it made following those stories very interesting.
Yeah.
And also, I think it gave us a little bit of an edge because the more you know about the playbook, the better investor you are. There's very much this game of uh, chess in investing, particularly in distressed investing, where you kind of have seen the moves before of the different players and how it turns out, and it's helpful when you
Yeah.
position your portfolio.
Fascinating stuff. So I want to fast forward a little bit to the Lehman bankruptcy. And obviously, you mentioned Lehman earlier. So, what was that like to experience the Lehman bankruptcy at Canyon? And I was really impressed in terms of how you guys kind of unwound your relationship with Lehman, even in advance of it really getting into trouble. So you didn't have, again, you didn't have to deal with them as a trading partner. So, but tell me what it was like witnessing Lehman bankruptcy, because we're coming up on another anniversary.
It was traumatic for different reasons. One is, yes, we did a good job unwinding our relationship with Lehman, but that didn't help us
Yeah,
in terms of losing money. I mean, that we had a dramatic year, like a lot of hedge funds. We were down more than 30%. Um,
yeah,
and so looking at your losses, you just feel nauseous. You
yeah,
literally feel sick losing other people's money to that
yeah,
extent. That was how it
yeah,
felt. You woke up every day and felt, at least I did, felt so ashamed and so
yeah,
stunned at the scale of the losses. So that was there was that the shame and the feeling embarrassed and feeling like it really feeling like you don't know what you're doing, and so
yeah,
all your confidence is basically shut. The second thing that happened is that the markets, our markets, high yield and leverage loans, were frozen. So you'd wake
yeah,
up, go to the office, look at your portfolio, see where things were quoted, but you could not transact. So even if
yeah,
you had a good idea about swapping one bond for the other, it was like, speaking in an empty ballroom. No one
yeah.
was there to trade.
Right.
So that was very difficult because it added to the feeling of impotence, of not knowing what to do. On top of that, there was a huge backlash and feelings of dislike, hatred, resentment
Yeah.
against Wall Street in general and investors in particular. So, this was not a proud moment. It wasn't a proud moment for somebody working in
Right.
the industry. Everybody had responsibility in that crisis, right? Yes,
Sure.
we investors, we Wall Street in general, I'll take the that as collectively over levered
Right.
and went overboard in the risk profile, that's for sure. But the incentives were there to
Right.
do so, right? There was particularly lax rules about leverage for banks, very lax rules with people signing mortgages,
Yep.
with people checking who was asking for mortgages and whether they could fulfill their payments. Those were packaged in highly levered collateralized mortgage obligations. They were rated by rating companies that were very lax in their rulemaking and their rating.
Right.
So it was sort of a pyramid, or that built one level at a time on very moving ground.
Right.
And when there was a little earthquake, the whole thing came crashing down. And I think there was responsibility at every level.
Yep.
Of course, you could say the CEO of Lehman Brothers has more responsibility. He should know better than the guy taking a mortgage to buy his
Of
house,
course.
who, is not sure he can pay the mortgage he just took out. That's probably true. But, all this, you put this all together, and it was a particularly tough time emotionally, physically, professionally.
Yeah. As you know, and I think absolutely right. There were a number of contributing factors, and there are a lot of people responsible. A lot of people like want to point figures that there was, it was just the banks, or was the people issuing subprime, but it was right many years, I think, in the making. But as you tell the story, this also leads to start the end of the golden age of hedge funds. I think you say that around 2009 really kind of ends kind of this era where hedge funds could deliver this outperformance, and 2008 2000 2007 2008 laid it bare, because what were hedge funds supposed to do in a crisis like that? They were supposed to outperform, and we know they didn't do as bad as the S&P, and they kind of took it up as a narrative. Well, we were only down 15 to 20%. We weren't down 40, so invest with us. But yeah, they didn't do what they were supposed to do. I was reminded of Simon Lack's book before you mentioned it. I was like, this is very like his book, The Hedge Fund Mirage, where you point out some of the issues that led to the decline of hedge funds, where a lot of the big hedge funds started to get too big, and it was an issue of scale. But why? Kind of what happened? Do you think, besides that, like that led to kind of this era that ended the golden age?
You're right, hedge funds failed to hedge. That's for sure. It was a disaster for the industry in terms of failures. So a huge number of hedge funds had to close. And what you realized is that in order not to close after a catastrophic year like that, you had to have two things: scale and a set of business lines. It was not enough to just have one hedge fund, particularly if investors could take their money on a quarterly basis, because after a very deeply negative year, investors would take their money, which means that your management fee would decline, which means that you had less money to pay your professionals in your back office. Probably a few would leave, the quality of the team would suffer, and then it would be, once your people leave, these are your assets. That's the raw material of a hedge fund. If your best guys leave, you're pretty much done for. So I think it was a realization that the business of hedge fund has to change, and it has to be more along the lines of a one-stop shopping financial service firm, where you offer maybe an evergreen hedge fund, maybe a locked up fund, maybe a CLO product, maybe a long only product. Later in the years, maybe an ETF, maybe maybe an ESG fund. The name of the game became to be really a captain of industry with a large range of Chinese menu of products that it would ensure that if there's one product that does particularly badly, or you have one year that is very completely traumatic, maybe the hedge fund is suffering and people pull money out, but they can't pull money out of some other products, and that ensures sort of the longevity of the firm. So hedge funds started becoming bigger and bigger and offering more products. And with that scale and that size, yes, they became more stable as enterprises, but they also became a lot less likely to beat the market. And Simon's book, The Hedge Fund Mirage, proved it very well. And I cite some of the same research and some other research that I updated. But basically, ever since, hedge funds in general have not beat the market consistently. And the vocabulary matters, because you hear in the media that this hedge fund was up 50% and this other one was 40%. I am not saying that some hedge funds don't beat the market sometimes.
Right.
Of course they
Sure.
do. Of course, in any given year, you have a number of hedge funds that beat the market by a
Yep.
lot. But if you think of the hedge fund as an industry, as an entire asset class, hedge funds have not beat the market consistently since 2010.
Yeah.
That means it's a different proposition, right? Because before that, when I entered the business, the value proposition, which every industry has one or every
Sure.
product has one, is we shall charge you a very high fee, but we shall deliver
Right.
consistently an outperformance versus the
Yeah.
market. And I don't think that's the case anymore.
No, I think you're right. I think you're right, unfortunately. And you have a good line where you say it's more lucrative to be a $20 billion fund that produces no return rather than a $1 billion fund that produces a 10% annual return. So
Right.
scale dwarfs skill. And you're seeing that. I think some of these hedge fund managers have caught on because all you see are they're being asset gatherers rather than, delivering returns.
Yes, and there's a very good study about that phenomenon, about hoarding
Yes.
assets, and it is more lucrative to be a hoard fund
Yes.
than a hedge fund.
I think you say we should call them hoard funds, right? I like that. And what are institutions supposed to do now? Because they can't get fired for going with the brand name, so that's what they do.
That's exactly what they do, and they're sort of foregoing outperformance for safety, and that's okay. I think there is definitely a place in a portfolio for safety. What I think is dangerous is to continue paying the fees that you used to pay for performance, the same fees for safety. That cannot work in finance. You know, risk reward is a real thing. So if you pay for safety, you shouldn't be paying the same fees as you did for outperforming the market. And I think this is not new. You know this very well. There's a very solid push for reducing fees at hedge funds, and I imagine it's going to continue, and it's going to erode very dramatically over the next few years. I'm not saying that there's no room for hedge funds in a portfolio. There absolutely is, and there'll continue to be, if only for diversification. But then again, if you're seeking diversification rather than outperformance, you'd better make sure you're paying the right price, and you'd better make sure that it is indeed diversification, which is not always clear, right? A lot of hedge funds claim that um, they do things differently and they focus on very complicated situations and out of the norm opportunities. And then if the market is down 20%, they are down 15%. Well, that's not really diversification, is it? So make sure it's good and make sure it's cheap or cheap enough for what you're getting. But I think investors, particularly US investors and institutions, they're no fools. They see the numbers and they don't want to pay 1.5 and 20 for evergreen funds anymore. I think that's here to stay. But the great thing about the investing field is that there are a ton of creative, smart people, and they will come up with new ideas. I talk to some young people who have better ideas than the hedge funds that were set up in my days 25 years ago. There's going to be changes in the fee structure, in the way to invest, in what they invest, and how they invest, and I think there'll be my gut is that there'll be new names of hedge funds that outperform rather than the mammoth hedge funds who really benefited from this golden age of the 90s, 2000, and 2010.
Okay, that's interesting. So you mentioned you're talking to some new people. I want to bring up, because this is a book also about women in hedge funds. And throughout the book, you follow your career trajectory and you get more into the lack of women in investing and particularly in roles of portfolio management. So talk to me, because when you joined Canyon, were you the only woman or there was one other woman there?
There was one other woman who retired a few years after, or quit a few years after.
Okay.
So for the longest time, I was the only woman in the investment team.
Yeah.
Yes.
And then you noted you never met any other partners that were women along and this is over,
I
you
met
met
one.
one, right?
I met one who was a partner, Meredy
Already
Moore,
more.
who's
Yeah,
a very good friend of mine and who started and managed her own hedge fund, Watershed, for
sure.
decades.
Right.
But and this is very much to the point we were making. I think one thing that has to change, and is changing very, very slowly, is you can't sell to investors the fact that you're different from the market,
Yeah.
you have a unique way of investing, you look at opportunities differently, and then have the same team of 10 white guys from Harvard than the other 100 hedge funds.
Yeah.
That's just not credible. I think that's becoming more and more transparent to investors, but that also shows in the numbers. If you have an investment team that looks and feels and acts like the next
Right.
guys, they're going to invest in the same things, right? They're going to come up with the same ideas and the same conclusions. So it wasn't a big deal for the first 20 years or the first 15 years of hedge funds, because we were essentially, there were very few of us and there were tons of investing opportunities. And so there was room. It was an immature business. We could name our price and we had more opportunities than there was money chasing those investment opportunities. And that's a very inviolable position to be in. But as the industry mature and becomes very competitive fee-wise, and with fewer opportunities, then it becomes really critical to have an excellent investment team, an excellent marketing team, and one that really has a diverse set of opinions, a plurality of views, etc.
You brought up a great point in the book, because you've said, like, now you've acknowledged, yes, the investors make the money, but now it's more about the marketing, but yet the economics haven't shifted to help the people that are really doing the marketing, which I thought was a great point.
That is interesting to me, and I'm sure you see that in your particular business dealing with hedge funds. But it seems to me that in any mature industry, the brand name becomes very important, right? The story around the product, less the efficacy of the product itself. And I, usually say, look, I'm not going to buy a pair of Gucci glasses because I see better with those glasses, right? I buy it because the brand is good. It says something about the quality. It says something about where I bought it, and maybe how long they'll last, and how good they
Yeah.
are, right? And it's a little bit like that. I don't think people invest in those big hedge funds, Canyon and others, because they help them beat the market,
Yeah.
because they don't.
Yeah.
But they are very serious firms. They've been in existence for 20 years. They have a great marketing team. They have a great IR team. So those are all good things, but that has nothing to do with the investment team. It
Exactly.
has to do with the investor relations team. It has to do with the
Yeah.
PR, which like that's
Yeah.
the crux of your business. It's the wrapping of the
Yep.
product. It's the presenting the offering in a nice way.
Talking about risk and performance, I think we'd be better suited looking for more women run hedge funds, because, as you noted, there's a lot of research out there that talks about, I don't remember the specific study you cited, but there is research showing that men take on more risk but deliver lower returns.
Yes, there are several studies, 3 or 4 at least, with different context and at different times, that show that on a risk-adjusted return, women are better. And I'm not saying obviously that women are systematically better. That would be silly. All I'm saying is investing is a team sport. Let's take football, because I know something about that. You can't have a football team made of 10 goalies. That just doesn't work. And to me, I look at some of those investment teams and there are 10 goalies.
Right.
They're going to act one way instead of having a better, just like a team helping them. And gender is definitely one area where there needs to be improvement, but not
Yeah.
only, there are minorities are,
Yeah.
not there, not present
Right.
in hedge funds.
No, I imagine the numbers are even worse for minorities. You cited a 2015 survey that said only 2% of hedge funds are run by women. So we
Right.
need to improve those numbers. So I want to get into why you decided to write the book. and what that process was like. So you retired in 2018, and then what happened?
Maybe I'm a very slow person, but it dawned on me that, gosh, there were really few women in that
Yeah,
business, and it just, as long as I was working there, it was a very difficult issue to bring up. It certainly doesn't make you popular,
yeah,
and it's hard to have your day job and then on top of it be the advocate for your kind.
sure.
It's very tough. I think a lot of women and minorities are sort of tasked with both. You need to represent your gender and be super good, and on top of that, you need to advocate for your kind. And it's like,
Right.
what else do I need to do? Anyways, so after I retired, having sort of nothing to lose, I wrote a little article
Hmm.
that was picked up by Business Insider, and it brought me a lot of joy to write what I thought.
Hmm.
And so I just, started thinking, what is there a book by a woman about women in hedge funds? And there was
Hmm.
not. Is there a book that's light and funny about hedge funds? No, the most of it is dry as toast and
Right.
serious as the Pope. Um, and so I thought, well, maybe I can write a book.
Yeah.
And that was as light as that. I started writing.
So tell me about that process. How long did it take, and how did you then? Did you write the whole book and then look for an agent?
The writing took a year. I had a writing coach who became a friend and who's fantastic, who helped me not with the writing, but the structure.
Okay.
Sort of put things in order, arrange the furniture in a room, and then told me, okay, you got to write this many pages about this, and then we would go back and forth. He would make comment, and that process was actually incredibly
Mm.
enjoyable. I loved it. I had so much fun, partly because I like writing, but also because he's great, and his name is Stuart Hortz.
Mm.
So we did that. That was fun. The part that's less fun is to find an
Yeah.
agent, and then after that, the agent has to find a
Yeah.
publishing house. It's an exercise in being rejected,
Yeah.
to be honest. I had to write a book proposal that you send to, I think I sent it to 60
Wow.
different agents.
Okay.
I got a yes from 2, and I picked one.
Okay.
And this is an industry that never ceases to baffle me, because to this day, I don't think anyone read the whole book.
Yeah.
I think they read the 10-page book proposal, but
Yeah.
I don't think they ever read more than that. And then my agent, God bless her, Leslie York, found a publishing
Yep.
house. And again, I don't think anybody there ever read the book.
See, this is yeah. This is I think this is interesting that people. I think publishing one is ripe for disruption. I know there's a lot of consolidation going on right now, but just the process in terms of getting published, authors don't know, how many books they've sold. They don't know what's involved. How did you find? And I know you've done a great job marketing and doing publicity on the book, but that's mostly fallen to yourself. What surprised you most about the publishing process?
I mean, exactly what you said. So people should know, and this is not only my experience, it's the experience of a lot of other writers, first-time writers that I've talked to. The publishing house does not promote your book. Not I mean, they'll send a few emails, but that leads nowhere, because, we all know we get 200 emails a day, and how many do you respond to? Almost none. So they do zero promotion. Even the most basic sort of sale job that I would think is easy. I went to Stanford Business School. One would think that they're going to pitch the Stanford bookstore, right? But no, they have, an entire aisle devoted to Stanford alumni who wrote a book, but mine was not there. I had to actually forcefully contact the bookstore manager and ask them. So any promotion, and all promotion, comes from the writer. It has to be. I think publishing houses are interested in promoting books from famous people, who of course don't need the promotion because they're already famous. So why would you need to? But that's the kind of stuff that baffles you. They don't want to take the risk. I mean, really, Stefan, it amazes me that once in a while a new writer comes to light and is able to publish and flourish, and we're aware of their books, because it is such a treacherous road. Basically, they want to publish cookbooks, self-help, and books from famous people. If you don't, from celebrities. If you don't fall in those categories, it's going to be very hard, and you're going to have to, at least I had to take what I could and then promote as best as I could.
Yeah. And how did you do that?
I talk to people like you, you network. Yeah. Basically, you have to view the book, or at least my philosophy was, I have to view this book as my business, as my portfolio, and because nobody else is interested in your book. Right. I mean, right. No one is going to be more interested in promoting your book than the person who wrote it. And so you go to business schools and you ask if they will have you as a guest speaker. Yeah. And, people that you may know other people who may know other people, and maybe they have a podcast, or maybe they have, and then once in a while, there's a huge stroke of luck. Somebody sent my book to a book reviewer at the Wall Street Journal who wrote a fabulous review. And I had no idea I didn't send him the book. My publisher certainly didn't send him the book. He got it from a friend of his. So it's just, lightning once in a while.
It's definitely not a science. It's definitely an art. But, first of all, congratulations on the book. It is well-deserved. And I think, your mission too with the book is to try to get more women into investing and to show what it's like. And I think that's really, really noble.
Thank you for saying that, because I should really also say, I don't know how you can make a living out of selling a book. I mean, right. you got to write a book that's a hell of a lot better than mine, because, with what I make from the book, I'm going to, maybe buy a used car for my teenage son, but that's about, and even that is a maybe. So thank God I had a career in finance. But the money is just not there. At least for me, the goal was a little bit different, which the goal was to try to attract some new people to the field. And in that respect, I did go to lots of conferences, lots of business schools, lots of finance classes in colleges, and met a ton of people, women, but not only, young people, and that is pure fun. That is pure fun for me to talk about the business, to answer questions, to see if, they're going to be the future of the business. And that's great. That's great.
That's fantastic. So before we end, since we're a podcast about finance and investing books, you do mention a few in your book. You mentioned Liar's Poker by Michael Lewis, When Genius Failed by Roger Lowenstein. We talked about Black Edge by Sheila Kolhatkar. We talked about Hedge Fund Mirage and Simon Lack, and John Coates, The Hour Between Dog and Wolf. And I think that was. But you also mentioned Ray Dalio's book, don't you?
I do. Man, that was a slug to go through that one. I read at least half of it. Yeah. Let's put it that way. It is a serious book.
Yeah.
But if you like self-help and preachy, go right. I'm very mean. No, it's look, it's a certain type of book that I'm sure a lot of people will love. I have a lighter tone.
This is a book without pretense. It has so much to offer, and I think it has a long shelf life too. A lot of times we see books that come around for a moment. That's the other thing about publishers; they don't give them the time. And this book will, I think, age like a very good wine. So,
just like me, Stefan, just like me.
Anything else going on? I know we were going to connect in New York, but you're too busy. So even though you're retired, you're doing a lot. Tell me what you're doing.
I am on the board of a few companies, and I'm still hoping to see you at some point in New York when I go for a board meeting. I ride my horses, and I generally enjoy life. That's my program.
That's awesome. Yeah, I think you said, I've spent the first half of my life making money. I'm going to spend the next half spending it.
Yeah, and I really got to slow down in the spending, because that's not going to...
We didn't even get into the horses, and there's so much there, but we're at time here. The book is Damsel in Distress. You can see all my notes there. But my life in
Very
the
studious.
Very studious. Dominique, thank you so much. This has been really enjoyable.
Thank you so much.